Amazon alone would account for 5% of the US economy. Right now it accounts for 2%. Okay, Amazon is in the news because employees, and I'm shocked to hear this, are trying to encourage the new CEO to drop his return to office mandate. Guys, I'm absolutely floored that employees are against coming back to the office and having accountability and being, I'm absolutely floored by this.
Me too.
You know, back when this whole COVID thing started, and they said the new norm is going to be people staying at home and working. I said, no way.
Doesn't sound realistic.
Well, and the reason being, as a business owner, forget about as a business owner. As a friend to people who work from home, I know that they're not working from home.
I have so many friends that work from home. They're like, oh, I'm just so productive. I'm like, you have a newborn and a new dog that you just got. How are you?
Yeah.
How are you productive?
And you're going to the store and you're doing all these things. You're
Exactly.
running errands. The other thing is, there is the camaraderie of being in the office.
I agree.
There's the rapport of having people face to face, people might say, oh, you can FaceTime or Zoom. It's like, well.
It's not the same.
You know, Tim Zoomed me this morning. Mm-hmm. If he'd come into my office, I was paying a lot more attention to him. He comes in my office than on the Zoom. On the Zoom, I was doing other stuff. I was just listening to him. If he's in the office and present in front of me, I was like, oh, I had to listen to him much more.
So I will say this. When my dad was working, he was traveling overseas a lot and going to meetings, and he'll go for a couple of hours to have a meeting in London or something. And I was like, why do you do that? Why don't you just have a Zoom call? And then I started going and meeting more people, and I was like, oh, now I see. It's way more effective to meet in person than it is over Zoom.
Oh, absolutely.
Especially if you're trying to get something done.
Absolutely. So when I see this Amazon stuff, I think to myself, okay, first off, they have like 1 billion employees. But then we talk about Amazon, the company. Now, Amazon is something that has just owned my brain for a long time. I don't understand Amazon. Let's pull it up in our software and start taking a look at what we think about. Here's the reason why I'm confused by Amazon. First off, gross margin, 13%. You look at a company like Walmart, you might sit there and say, well, Walmart's just retailer. Then why is Walmart's gross margin double what Amazon? I mean, Amazon has AWS, this very high margin, fast growing business.
Right.
Profit margin in the last 5 years, about 4%. And last year it lost 0.5%. Now, I will say their cash flow has been negative, which doesn't bother me because look at their capital expenditures. It's skyrocketed. Their capital expenditures have skyrocketed. It used to be in the low to mid teens. Now it's 60 billion last 2 years. Mm-hmm. So yeah, this is going to be hurt. What was that, Mo?
They're going for it.
Well, yeah, because they're trying to build this network.
Exactly.
So they can be everything to everybody.
Exactly. So
So the question you have to ask yourself is that going to be a profitable thing in the long run?
it's a hard bet to make. It's hard for me when they have this Amazon Web Services just driving everything, and it's the only thing keeping them afloat at this point. That's the hard thing for me.
So that's the thing, guys. Of all their business ventures, AWS right now, for a few quarters now, has been the only profitable part of the business, which is fine. But there has to be a path to profitability on the retail side.
Right.
Their advertising portion of the retail side is getting better, and that's a very high margin business. But when I look at Amazon and I look at this cash flow for the last 10 years, it's been growing 2, 7, 10, 6, 17, 21, 26. And then these 2 years of negative cash flow. Look at these astronomical capital expenditures.
And I think that's another thing that puts it in the too hard category. It was fine, and then this happens in the last 2 years, and you're like, okay, well, how do I normalize that?
Well, but you can go figure out what they did.
That's true, but when are they going to stop doing that?
That's the question.
Or are they going to stop doing that?
So let's go back to the previous decade when Amazon was still generating good free cash flow, decent free cash flow. Hit a few $1 billion a couple of times. Their income statement didn't look as good because they're probably depreciating all that. But is this a high capital intensive business is my question. Is this a business that requires a lot of capital to stay really competitive? To which I would say, then this sucks.
Yeah.
This feels like a car business to me now. Now, there's a lot of great value investors who love Amazon, have had it for a very, very long time. So I'm completely saying that they see something I don't see, but it's very difficult for me to look at Amazon and say no brainer, apart from the excitement of how big it is.
Yeah, and then you can get a package to your door in an hour.
Yes, and I love that. And I'm so spoiled now that when I see something that says deliver tomorrow, I'm like, tomorrow? Ugh.
I know.
I gotta wait. Absolutely love that. But again, at some point, I need to see the dollars start flowing in big time. So one of the things I would do with Amazon is figure out what these $60 billion in next decade in capital expenditures have been. Like, this is a big jump. When people tell me it's distribution centers, it very well could be. But this is, 4 times more. It has to be airplanes, has to be all these things, the cars, all these things they're doing. What's the useful life on those? How are they going to be depreciated? And then how do you justify those write-offs, the depreciation, with this gross margin? This has got to increase significantly. Significantly. It cannot stay at 13% and have a well-run business. Now, let's go look at previous years and look at the growth. And by the way, gross margins before depreciation. So if somebody tries to tell me, well, it's all because of no, that's to the bottom line net margin. Gross margins is on their goods. So look right here. Oh, wow. It actually hasn't been that great. What is going on here? I thought they had oh my gosh, this is terrible. It's always been bad. And Amazon has completely owned my brain. Completely, absolutely owned my brain. It's up 2% today. That's interesting.
Yep.
And now the market's back up today.
Of course it is.
So when you look at this and look at analyst estimates, Mo, what were you looking at?
I was just trying to see if I could find their capital expenditures. So cash provided, capital expenditures including leases, improvements. Let's see here. Cash used in investing $59.6 billion, $58.2 billion in 2020 and 2021 with
investments in additional capacity to support our fulfillment operations and in support of continued business growth and technology infrastructure. Yeah. Which investments were, we made cash payments that are, this is the same stuff. They're going to say at some point, they've got to start making money on that. Like significant money. Because Mo, what's the market cap? I'll look it up. Hang on a second. The market cap is $1 trillion, guys. So a company that large, if you apply a 20 multiple, you need $50 billion in free cash flow and earnings. We're nowhere close to that. What did we do in free cash flow? We had negative free cash flow. What were earnings last year? It was a loss. In their best year ever, they did $33 billion in positive profit.
How much free cash flow did you
and $14.6 billion of it was other income and expenses. They had negative free cash flow, of course.
Yeah, negative.
So they need to get to $50 billion in free cash flow.
Their highest free cash flow was $25.93 billion, and that was 2020. That was when the world shut down and everybody was using Amazon.
Yeah.
Best case scenario that they could possibly have.
Now let's go look at analyst estimates. Analysts expect $1.72 in profit this year per share. The stock's currently at 96. Divided by $1.72. What is that? 55 PE, something like that. Okay. 2027 though, $8 a share. All right, listen, I hope that happens. It still makes it a 12 times PE for 4 years from now. What's the 4-year PE on anything? 4 years from now, it should be much lower than that. Look at revenue. Okay, $575 billion estimated this year, almost $1 trillion in 2027. Man, good growth here on revenue.
Yeah, it is good growth on revenue.
Good growth. And they have a decent ROIC over the last 5 years. I'm surprised to see it was 9%.
Yeah, 9% on the nose.
I'm actually surprised by that. I thought it'd be lower than that. So let's do stock analyzer tool, Mo. Okay. I'm going to do a 20-year analysis. You do the 10-year. Now, guys, it's especially important. And if you like the software and you like the stock analyzer tool we're about ready to do, we're running a special right now, $7 for 7 days. Come check out the software. It's literally $1 a day to test it out. Join the community of thousands of people. You can have this is literally justifiable if you just want to analyze one company and talk to people about one company. That's it. And this is the reason why this is going so well for people is it's a community of like-minded investors who can talk to each other about investing without getting egos involved and all that stuff. So, Mo, you're going to do a 10-year, I'm going to do a 20-year analysis, and I'm going to do we're going to do revenue growth, profit margin, a new exclusive video, free cash flow margin, assigning a PE and price to free cash flow, and then a desired return.
Okay.
I'm doing it for the next 20 years.
Okay.
All right, so profit margin. Okay. So guys, it's hard to do when we're looking at these companies, when I go at 20 years, I do a much lower revenue growth assumption. And the reason being is it's 20 years out. The company's expected to hit $1 trillion in revenue in the next 4 or 5 years. What's it going to do in 20? Is it possible to go 10% a year for 20 years? No, but I put that in there. But I'm going to show you how ridiculous this number is. They did $500 billion last year, right?
Yeah.
So 10% a year for 20 years.
Oh boy, here we go.
Oops.
I love this.
1.1 to the 20th power would take us to $3.4 trillion in revenue in 20 years. Okay, maybe. What would the US GDP be by then? If nominal GDP growth is call it 4.5% a year. Let's call it 5% a year for 20 years. And we're currently at 26 trillion. $69 trillion. And they're expected to do 3.3 of that. Amazon alone would account for 5% of the US economy. Right now it accounts for 2%.
Yeah.
Okay, okay, maybe.
Not terribly off, but
this is still a high number.
Ideal situation.
For the almost the largest revenue company in the country to grow 10% a year for the next 20 years, that seems difficult, but it could.
Yeah.
So I did 4, 7, and 10. Mo, what'd you do?
I did 6, 9, and 12.
Okay, for 10 years.
Yeah.
Profit margin, I did 3, 4.5, and 6%.
I did 2.5, 3.5, and 4.5.
Okay. Free cash flow margin, I did the same 3, 4.5, 6%.
I went lower. I went 2, 3, and 4.
Okay. PE, I did 15, 17, 19.
I did the same thing.
Same with price of free cash flow. Yep. And for the return?
I did 10, 12, and 14%.
Okay, the stock's currently $97. I have a low price of 25, a high price of 70, middle price of 45. I have it on my watch list at 60. I should probably change that to 50. What's yours, Mo?
I'm 18 to 24, 50 to 57, and middle about $35. Watch list of 60. Yeah, I'll probably bring that lower
guys,
too.
the point here is, to us, it's just overpriced. I don't care which metric you're looking at. We could have the range be, and the ranges always change depending on how far out we look, the assumptions we make. It's always going to change in every video. But the key here is the stock's going at 96, and assuming the best case scenario that I view, it's a $70 stock. I'm out. So thanks very much, guys. Again, $7 for 7 days. Check it out.